Hey everybody, it's Mr. White here with part 2 of the Federal Reserve and Banking System Notes. Follow along and continue where we left off, and we're going to talk mostly today about monetary policy, and we're going to get into some of the mechanics of how that works. This is a little bit more technical than the last set of notes, so you might also want to have out a calculator so you can work through a couple of different practice problems as we go through this. And since I know most of you are watching this on your phone, yeah, get a calculator or get your laptop, pull up the calculator on your laptop, and let's go. All right, so as I said at the end of the last video, there are 3 tools of monetary policy: open market operations, reserve requirements, and interest rates. So let's go through all 3 of them one at a time. We'll talk about what they are, how they work, and how the Fed uses these tools to stabilize the US economy in the event of a recession or runaway inflation or whatever the case might be. So the first thing we're going to talk about is open market operations. Okay, open market operations is really important because it is the most frequently used monetary policy tool that the Fed has at their disposal. This is how the Fed increases and decreases the money supply. So whenever you hear the term open market operation, we're talking about buying and selling US government bonds. If we buy bonds, the money supply will increase. This is what's sometimes referred to as quantitative easing, or QE. So if you want to sound really smart now, you can talk to your friends about quantitative easing and you'll actually know what that means. Now, the Fed can also decrease the money supply by selling government bonds to the public, to banks, to pretty much anybody who will buy them. Okay, so back to open market operations. So it's all about buying and selling government bonds. And when the Fed does this, it changes the money supply and circulation. So let's say, for example, if we are in a recession or something like that, and let's say that the Fed wants to help banks have more money so that they can lend more money to businesses and to individuals. Well, what they're going to do is they're going to buy the treasury bonds that the bank is holding on to, right? If the Fed buys bonds from the banks, it gives the banks cash, which increases the money supply and circulation. This is what's sometimes referred to as an easy money policy. It's expansionary monetary policy. The whole goal is to expand the economy by putting more money out there. When more money goes in circulation, banks have to compete with each other to loan money to other people. Banks are in the business of loaning money and charging interest. That's how they stay in business. So since all the banks are competing, if all of them have a lot of money to lend out, it makes sense that the main way they're going to compete is by offering lower and lower interest rates. So the more money that the Fed gives to the banks, the lower the interest rates are going to go. But the downside is that the more money that the Fed gives to the banks, the higher that the inflation rate is going to go. And this encourages banks to lend money to consumers because if they've got all this money sitting around, they don't want it losing value in their vaults. They'd rather be loaning it and charging interest. And for consumers, it discourages them from saving money. When interest rates are really low, the opportunity cost of putting money in a bank account that's not earning hardly any interest is really high. You would rather have the liquidity of having that money in your pocket, because if it's not earning very much interest in the bank, it's just more useful to have it someplace where you can use it to buy goods and services. Okay, so if your head is spinning, let's just think of it this way. If the economy is kind of slow and the Fed wants to speed things up, if they want aggregate demand to rise, they need to give more cash to the banks. When the banks have more cash, they have an incentive to lend that cash. And when they lend that cash, more economic activity happens. More businesses will open, more people will buy cars and houses and things like that. So what's going to happen here is the Federal Reserve is going to buy the bonds from the bank, and they're going to give the bank cash money in return for the bond. Okay, so they've just bought the bond. Now the Fed has a bunch of bonds sitting in their vault out of circulation, and the bank has a bunch of cash money which they're going to put out into circulation. Okay, so when the Fed buys bonds, it makes the money supply bigger. Now, the other side of this, if the Fed wants to decrease the money supply, they're going to sell bonds to the banks. that takes money away from the banks and it decreases the overall money supply. This is what's sometimes referred to as a tight money policy, okay? It's contractionary by nature. The goal is to slow the economy by increasing interest rates. The reason why interest rates will go up if the Fed takes cash away from the banks is because when all the banks don't have very much money to lend, then there's not much competition for lending, right? None of the banks are lending money, so there's only a few big banks that have enough cash that they can actually still lend money. And when there are fewer and fewer banks lending money, the banks that are lending money have less incentive to lower their interest rates because they don't have very much competition. And so generally, the less money that's available out there in circulation, the higher and higher interest rates are going to go. When interest rates go higher, businesses don't invest, consumers don't make big purchases, and as a matter of fact, a lot of consumers are going to decide to save their money. Just think, if you see that the bank has a really high interest rate right now, you're more likely to go stick that money in the bank and earn a whole bunch of interest instead of keeping it in your pocket where you might spend it. Now, altogether, this restricts the size of the money supply and it slows down economic activity by decreasing aggregate demand. And so this is what it looks like, right? Let's say the banks have a bunch of cash, the Fed has a bunch of bonds. They can say, hey bank, why don't you buy this bond? And the bank can say, okay, Fed, well here, have some cash. Well, now what's happening is the bank is loading up on bonds. And remember, bonds aren't liquid. You can't loan a bond to anybody. And so that slows down bank lending and it slows down buying and spending in the economy. Meanwhile, the Fed is stashing a bunch of cash money in their vault. And when cash money is in the Fed's vault, it's not circulating. And so it's not contributing to economic activity. And so the idea here is not to just, throw the brakes on the economy. We're not trying to stop the economy. But what we're trying to do is we're just trying to slow things down a little bit. It's kind of like if you're speeding and you see a cop, you don't want to slam on the brakes. You just want to, take your foot off the gas and maybe, give the brake a good little tap. That's sort of what's going on here. We're taking our foot off the gas, economically speaking. So here's a summary of open market operations. Remember, open market operations means buying and selling bonds. If we want to expand the economy, like during a recession, we're going to do an expansionary policy and we're going to buy bonds because remember, buy equals big. When we buy bonds, the money supply will get bigger. If we want to slow the economy down because of too much inflation, maybe we're in a long expansionary period and unemployment is so low and prices are getting really, really high, what the Fed is going to do is they're going to sell bonds because when you sell, it makes the money supply small. Sell equals small money supply. So just remember that monetary policy is mostly based off these open market operations. And the whole point of monetary policy is increasing and decreasing the money supply. This is how they do it, by buying and selling government bonds. Now, another really important part of monetary policy is the fractional reserve banking system. The fractional reserve system means that banks hold only a fraction of their deposits as opposed to 100% of their deposits. Meaning that when you put money in the bank, like if you went and put $50 in your bank account, the bank doesn't actually have to keep $50 in the vault. As a matter of fact, they only keep a fraction of that. The part that they have to keep in the vault is called the reserve, the money that they receive from you, but that they're not allowed to lend out. Now, I hope this doesn't shock you too much, but this is actually how banks operate. They have to lend money to make money, and if you ever wondered where does the money they lend come from, well, it comes from people's bank accounts. Now, reserve requirements are there to protect consumers and also to protect the banks. It's a regulation on the minimum amount of reserves that banks have to hold against their deposits. So, for example, you might remember that during the Great Depression, when people got freaked out about the economic situation, they all rushed to the bank to try to get their money. But the banks didn't have any money. Well, after that debacle, the Fed decided that banks must have a supply of reserves to protect against these kind of runs or panics like what we saw during the Great Depression. And so right now, 10% of M1 must be reserved, meaning that 10% of all their cash and demand deposits has to be saved in reserve. So, for example, if somebody put $100 into a bank account, the bank is required to save 10% of that $100 in their reserve. but then they're allowed to lend out the other 90%. Now they don't have to, but it just means that that's the maximum they could lend out. 90%, the other 10% gets saved. Now, this is important because it influences how much money banks can create from each deposit. In other words, it influences the maximum amount of cash that can flow out into circulation every time you deposit money in your bank account. Now, if the Fed wants to slow the economy down, they can increase this reserve requirement. In other words, they can force banks to hold on to more money from your bank account. If the banks hold more reserves, they can't lend as much, and that tends to slow down economic activity. But if we decrease this reserve requirement, if we make it smaller, the banks don't have to hold as much of your cash in reserve, and they're allowed to lend more. When the banks lend more, the economy speeds up. There's more borrowing, there's more buying, and all that's good for aggregate demand. So let's talk about a couple important terms here. The first one is the reserve ratio, okay? The reserve ratio is set by the Fed, and it's just the minimum amount that has to be held by the bank, okay? Like I said, currently that ratio is 10% of M1, so like 1/10 of every deposit. So let's say, for example, if someone deposited $1,000 at the bank would hold $100 in reserve, and the other $900 would be available for lending. Now, when we say that something is a required reserve, what we're saying is the portion or the percentage of money deposited that must be held by the bank. In that previous example, the required reserve is $100, okay? Now, this may not be loaned out. You're not allowed to lend that $100. It has to sit in the vault, it just has to sit there, okay? The whole point of that is that if the person decided, along with everybody else for some reason, to rush to the bank and ask for their money all at once, the bank would not be in a situation where they would have zero cash, like what happened during the Great Depression. Even in a worst case scenario, they're going to have at least 10% of your money. And when you really think about it, today's mega banks like Bank of America and Wells Fargo, they have hundreds of billions of dollars worth of cash reserves. So there's very little chance that enough people would ever come in and ask for all their money at the same time to a point where a bank like Wells Fargo would not be able to satisfy their demand for a withdrawal. Now, let's talk about something called excess reserves. Excess reserves are bank reserves beyond the reserve requirements set by the Fed. So in that last example, the $1,000 deposit, we said $100 is the required reserve. Well, that other $900 is called excess reserves. Now, banks are allowed to lend out their whole excess reserve if they'd like to, but banks can also hold on to some of that excess reserve. Just think of it this way. If you only have a 70 in a class, you're passing, right? 70 is the bare minimum to be passing, so everything's good. But do you feel comfortable with just a 70? Probably not, right? So you'd probably rather have a little bit of a cushion. And just think that banks are the same way. Banks don't want to have just the bare minimum of reserves because if anything goes wrong, like let's say, for example, if a bunch of people come in asking for loans all at the same time, or if a bunch of customers want to withdraw cash all at the same time, the bank may not be able to meet their demand without violating the reserve requirement. And that would be bad because if a bank violates the reserve requirement, they can get sanctioned by the Fed, up to the point of even getting shut down by the Fed. So they have to be very careful about that. So one thing I want you to remember is that banks don't have to hold excess reserves. They can loan out 100% of their excess reserves, but in some cases, banks may choose to hold excess reserves. And so just keep that in mind. Now, the last thing is loans. That's the portion of the deposit that gets loaned out to borrowers. So the money supply does not increase until banks actually lend money out into circulation. And it's really important that they do that. And so the Fed tries to encourage them to do that by making it easier to get money if they did, for example, an expansionary monetary policy, or if they don't want the banks putting more money into circulation, they're going to make it much harder for banks to lend money out if they're doing a contractionary policy. So to understand money creation, we got to real quick talk about some accounting, okay? I don't know if you guys know much about accounting, but if you don't, that's okay. We're just going to learn some really basic stuff. When we do basic accounting, the most basic tool is to set up what's called a T account, and you see a T account right here, this sort of greenish looking table. It's just a simplified accounting statement that shows changes in a bank's assets and liabilities. Now, one thing I want you to know, and this is just really fundamental to understanding everything that we're about to do right here. In accounting, there is what's called the basic accounting equation, and it's very simple. It just says that assets must equal liabilities, okay? If you can remember that, you're in good shape. Assets must equal liabilities. Okay. Now, an asset just means something you own that's valuable, and a liability means something that you owe to somebody else. Okay. So a reserve or a loan is considered an asset to a bank because those are things of value that the bank has in their possession, right? Like if they've got physical cash reserves, that's valuable, and the bank's holding it, it's an asset. Or if they have a legal document for paperwork that shows that they loaned money to somebody and that person owes them money, that's also valuable, right? Because the person owes them money. Now, deposits, on the other hand, are a liability to the bank. A liability, remember, means something you owe to somebody else. And so when you deposit $100 at your local bank, the bank owes you that $100. So from the bank's point of view, it's a liability. But remember, the bank uses your $100 to lend to other people. And so when we do accounting, that's why we have to have assets equal liabilities, because the bank gets its money from its depositors, but it uses those deposits as assets. And so basically, whatever we have on one side of our table, like whatever we have on the left-hand column, has to add up exactly to whatever we have in the right-hand column. So what we always do is we start over here with liabilities, okay? We'll take a look, and we start off with $100 worth of deposits. 100 plus 0 equals 100. So down here is our total, $100 of liabilities, okay? Well, we got to come over here, and whatever's on our assets column also needs to equal 100. Well, we got $10 in reserve. We got $90 in loans. 10 plus 90 equals 100. So our balance sheet perfectly balances. Everything is good. And so we're going to use this balance sheet to answer questions, especially FRQ questions. Watch the FRQ practice video and you'll see what I'm talking about. But like I said, don't stress too much about this. It's actually pretty simple. It just takes a little bit of practice. And once you understand how to use one of these things, they're very useful, and there should be no kind of question that you can't answer about monetary policy if you understand one of these things. Okay, now let's talk about something called the deposit expansion multiplier. Of course, we've learned about some multipliers already, right? Like in the last unit, we talked about the spending multiplier. Okay, remember the spending multiplier, 1 divided by 1 minus MPC. Okay, and that tells us how much an aggregate, an autonomous change in spending can have on aggregate output in the U.S. economy. We also talked about the tax multiplier, which we kind of threw in with our fiscal policy discussion, where we talked about how we can measure the effect of like a tax cut by taking MPC divided by MPS and just multiplying that by the size of the tax cut. That'll tell us how much it'll benefit our GDP. Well, we can do a similar kind of multiplier with monetary policy, and we can figure out how a particular reserve requirement can impact money creation in the economy. In other words, what's the maximum amount of money that can go into circulation based off of an individual deposit according to the particular reserve requirement rate that's in effect. So the deposit expansion multiplier, like I said, just helps determine the amount of money in the banking system that gets generated with each dollar of reserves. It's very simple. The money multiplier is equal to 1 divided by the reserve ratio. So, for example, if the reserve ratio is 10%, the money multiplier is equal to 1 divided by 0.1. So the money multiplier is 10. Once we know that, you can just tell me what the deposit amount is. We multiply that by 10, and that'll tell you how much money could potentially be created in the economy based off that one deposit. So if the reserve requirement is lower, you'll see the multiplier gets bigger. So for example, if the reserve requirement were 5% instead of 10%, the multiplier would be 20. So then we would multiply whatever the deposit is by 20. Now, this gets to the idea of money creation, okay? You take the initial cash deposit and you multiply it times the money multiplier. The higher the reserve requirement is, the lower the multiplier is going to be. Or the lower the reserve requirement is, the higher the multiplier is going to be. So, for example, let's say if we had $100 deposited in a system with a 10% reserve requirement, we can calculate the multiplier as 1 divided by 0.1, which equals 10. What we would do is we'd multiply 100 times 10, and that gives us 1,000. So that means that as a result of that $100 cash deposit, the bank is going to be able to lend out $900, right? $900 is going to be lent out throughout the whole economy, plus the $100 initial deposit. You add those two together, that means the money supply grew by 1,000. If we had a lower reserve requirement, like 5%, let's say 100 times 1 divided by 0.05, which is 20, so 100 times 20 is 2,000. That means the bank would be able to lend out $1,900, or at least $1,900 would be due to bank lending activities, plus the initial $100 cash deposit. Now, this might be a little confusing. I'm sure your head is spinning slightly. So let's get a little bit more visual with this. Let's break this down. Okay, so let's say we got person A right here. You can see he's a stick figure. He's very well drawn, so this very well drawn stick figure guy here, maybe that's me. He kind of looks like me. He's got my haircut, right? He's wearing a tie. I like to wear a tie. Okay, so let's say that I get $2,000. Maybe I got that from one of my investments. Maybe that was like a capital gain from some stock. I take my $2,000 and I go to Bank of America and I deposit that $2,000 in my checking account. Well, let's say that we're living in a system with a 10% reserve requirement, like real life. So if I deposit $2,000 into my checking account, by the reserve requirement, how much does the bank have to save? Yeah, $200. Okay, so $200 goes into reserve. And so then that means how much is left over? How much is in excess reserve? Yeah, $1,800. Okay, so that means the bank can lend out $1,800. And let's just say that Bank of America doesn't want to hold any excess reserves. They want to loan out every dollar they get. And let's say that the same day that I deposit my $2,000, like literally after I walked out of the bank, some woman walks in, person B, okay, and she says, oh yes, I need to borrow exactly $1,800. And Bank of America says, oh my gosh, what a coincidence. We have exactly $1,800 that we would love to lend you today. Well, what Bank of America is going to do is they're going to take that $1,800 of excess reserves, they're going to lend it to person B. But person B does not have a checking account at Bank of America. Her checking account is at Wells Fargo. So when she gets that $1,800 cash, she's going to go across the street to her bank at Wells Fargo, and she's going to deposit the $1,800 in her checking account at Wells Fargo. Well, Wells Fargo, when they receive that deposit, remember they got to save 10%, so how much are they going to put in the vault? Yeah, $180. Okay, so $180 goes in the vault. How much is left over for them to lend to somebody else? Yeah, it takes a minute to do the math. $1,620. You are correct. Okay, so as person B walks out of Wells Fargo, in walks person C, little guy down there. Okay, maybe he's gonna go get like an experimental growth treatment or something to make him taller. I don't know. Perhaps it costs $1,620. He walks into Wells Fargo and he asks for a loan for $1,620. And Wells Fargo says, oh my God, what a coincidence. We have exactly $1,620 to lend to you right now. And so Wells Fargo is going to lend him the $1,620 of excess reserves that they just got from person B's deposit. Now, person C does not bank with Wells Fargo. He's going to take that $1,620 cash. He's going to get in his car. He's going to drive to the other side of town to his bank, which is Chase, and he's going to deposit the $1,620 cash in his checking account at Chase. Now, Chase, of course, they're required to put some money in reserve, 10%. How much is that? $162. It would not be 1,000. And if they put $162 into reserve, how much is left over? Yeah. Take a minute, calculate it. Got it? Okay, cool. Yeah, $1,458. Now, if we just add up all the stuff that we've just done so far. And keep in mind, like, we're not at the end of our chain reaction by any means. This is just the beginning. But like, if we were to go back and add 2000 plus 1800 plus 1620, right? What we're going to get is 5420. Okay. If we add 200 plus 180 plus 162, we're going to get 542. Okay, we could just keep going and going and going, right? Until this number gets down to 0, right? Until both numbers get down to 0. But a faster way to do this would just be to use the money multiplier. That's why we've got a multiplier, so we don't have to sit here and go round after round after round. Just take the initial cash deposit, $2,000, right? Multiply times the money multiplier, 1 divided by 0.1, that's 10. Okay, whoop, there's 10. Okay, 2,000 times 10, 20,000. That's how much the money supply is going to increase. So in other words, like, if you were to keep adding all this stuff up all the way down, by the time you got to the end of the chain reaction, you would end up with 20,000. Okay, 2,000 of that is because of the initial cash deposit. Another 18,000 is because of all the bank lending that happened as a ripple effect from that initial $2,000 cash deposit. Okay, last of all, we've got interest rates, all right? And the interest rate that the Fed charges when member banks want to borrow is called the discount rate, okay? Now, it's important to recognize that the Fed is only supposed to be the lender of last resort. That means that they don't like to lend money to banks, but if there's no other option, they'll do it. Now, banks only want to borrow from the Fed when their reserves are too low because they've had too many loans issued or because too many people have withdrawn money all at the same time. In other words, if a bank goes below their reserve requirement, they could borrow money from the Fed, and the interest rate they would pay to borrow the money is the discount rate. Okay? Now, if the discount rate is low, it encourages more borrowing because the discount rate has an effect on interest rates that people pay all throughout the economy. So a low discount rate means everybody else pays lower interest rates, and that encourages people to buy more stuff, more houses, more cars, more businesses are going to invest, things like that. A higher discount rate discourages borrowing, meaning that if the discount rate is really high, interest rates in the economy are higher, and people aren't going to want to buy stuff, especially they're not going to want to buy stuff they need to borrow money to buy if interest rates are really high. Now, this is a little confusing. The federal funds rate is not the interest rate charged by the Fed. It's actually the interest rate that banks charge each other if they want to borrow money on a short-term basis. Okay? Currently, it's right around 2%. Now, the federal funds rate is always lower than the discount rate by design. The Fed always makes the discount rate 0.5% higher than whatever the current federal funds rate is. They do that partly to discourage banks from trying to borrow money from the Fed, but also just because of the fact that, like we said, the Fed is supposed to be the lender of last resort, so they don't want to try to compete with other banks to loan money, and that's why they're not trying to charge a competitive interest rate with those other banks. All right, so here's a quick summary of everything we've talked about, right? The Fed is the Central Bank of the United States. It's run by the Board of Governors. There's 12 district banks, and together they make what's called the Fed Open Market Committee. The Fed Open Market Committee conducts monetary policy. They can do open market operations where they buy and sell government bonds. They can change the reserve ratio, right? The reserve ratio tells how much of demand deposits that the banks have to hold in reserve, or they can change interest rates by directly changing the discount rate or by changing the money supply, which changes the federal funds rate. So here's a quick flow chart of how monetary policy works. Let's say if we're going to do a tight monetary policy to try to slow down inflation. Well, the first thing that happens is the Fed sells bonds. All right. When they sell bonds to the banks, it takes money out of the economy. When there's less money in the economy, this pushes up the federal funds rate. In other words, the interest rate that banks charge each other. If the interest rate that banks charge each other goes higher, that means that the interest rate that all of us, households and firms, are going to have to pay goes much higher too. When interest rates are higher, consumers and businesses have less incentive to borrow. And if they're not borrowing as much, they're not spending as much. Less spending causes a slowdown in the economy, and hopefully that'll slow down the growth in inflation. Now, if we're trying to speed up the economy, the Fed does a loose money policy. They buy bonds. Remember, we said buy equals big. Buying bonds puts more money into the economy, and that lowers the federal funds rate, the interest rate that the banks charge each other. When the banks charge each other lower interest rates, they charge lower interest rates to households and businesses. And that means consumers and businesses have more incentive to borrow money. More borrowing leads to more spending, and more spending causes GDP to rise. That's economic growth. Okay, guys, so that is it for our discussion of how to conduct monetary policy. Make sure you watch the next video, which is a little bit of practice on an FRQ question based on these monetary policy principles that we've just discussed. If you have any questions, make sure you email me or you can ask me in class. And I hope you all have a great day.